Let's get started. And as people join, they'll be able to come and join in. I wanna thank everybody for joining us for this week's Business Unusual. I'm Joe Campolo, and my co-host Peter Klein is here. And over the last month or so, we've been having these weekly webinars to track and talk about the economic recovery here on Long Island and sort of globally, and to look at the markets. We call it business unusual because nothing is usual about these times. Last week, we were talking about the impact that riots were going to have, and this week they're morphed into peaceful protests, and that doesn't seem to be any sort of issue that we're dealing at right now. We like to talk to business leaders in different sectors each week as well. So this week we are lucky to have Jim Coughlan, a principal at TRITEC. Jim and I have known each other a long time. We serve as fellow board members at HIA LI. And he's principal at TRITEC. He's the president of LIBI, the Long Island Builders Institute, and he's a co-inductee to the Long Island Business Hall of Fame with me last year. And we're going to be talking about a whole bunch of different things. But before we get to the real estate market, Peter, let's talk about the stock market, right? Again, business unusual,
gravity,
market's unusual, and the NASDAQ today hit a record high. So talk about that for a little bit. What are you seeing?
Just a lot of capital chasing fewer goods. It raises the price, and I think this is what we're seeing with the capital that's coming into the market. Perhaps it's a rotation from one group to another. Maybe it's rotating into small caps. They've gotten a big rise lately. Interestingly, the biggest jump from the bottom has been the companies with the worst, you heard that correctly, the worst balance sheets. So the companies that are arguably in more stress financially than other companies, again, stressful balance sheets, more debt, less cash, those are the ones that have outperformed. It's business unusual. It's markets unusual. It's very interesting, but also it causes someone like me, who's a fiduciary for other people's capital and their dreams and their nest eggs going forward, to be very mindful of the risks that this type of action brings in. It's nice to sort of dance while the music's going. My goal is to make sure my clients have a nice comfy couch to sit on when it stops.
Yeah, so the job market report seems to have fueled this latest surge. I think last week they reported we added 2.5 million jobs when we were anticipating losing several million jobs, and that's somewhat of a bounce, Peter. Is it a bounce? Is this sustainable? Where do you see it?
Yeah, I certainly think it's a bounce. I certainly think it's good for the economy. I guess it was unexpected. There's a lot of nuance with the Bureau of Labor Statistics, and these guys are the nerdiest of the nerds. I mean, they really put their life work into this kind of data set. And they are very unlikely to change and make caveats and asterisks and saying, oh, this time, this month, we did this differently. They lay it out there, and clearly it was a big miss for the economics profession to miss this. I think in large measure, there were a couple of things that were missed and had a big impact. Number one, the PPP program. Remember in May, you had a certain period of time to spend that money, and you had to use it on employees. So often there were a number of cases where employers would give the money to their employees, but there was nothing for the employee to do work-wise. So was that person considered unemployed or employed? They counted them as employed, and in reality, they may have been considered unemployed. There was a perverse sort of factor that the BLS uses every month. It's called the birth-death correction adjustment. And this month, they had assumed, this particular assessment had assumed that 350,000 new jobs, new companies were created in the month of May. It is a very mercurial and sort of volatile indicator and or metric, and so I don't think you should put too much faith into that. Bottom line is that I suspect next month's jobs reading will have more volatility around these numbers, and it's going to be like that for a while to come, I think.
Yep, that's great. So Jim, thanks for joining us. So let's start just with your macro view, right? So last 10 weeks or so, walk us through sort of what your perspective has been from that, March 23rd day when the governor said shut it down through today. What have been your macro observations?
Well, I mean, real estate, is a very capital intensive business, right? So it takes an awful lot of money to build significant projects. And so we are subject to the attitudes of both the institutional equity markets as well as the banks in terms of our abilities to get projects going. So we spend a lot of time on the phone with banks and with institutional equity investors talking about how they see the ability to invest in projects going forward. And of course, their willingness to invest in projects going forward has a lot to do with their certainty of the and reliability of the success of those projects, right? So, product by product, it's very different. Region by region, it's very different. But in general, I think if you're in the retail market, if you're in the retail property market or the hospitality property market, you've got a really rough road, right? When nobody really knows what the future of the big malls are, but they're probably not going to be the same thing that they are today. Mom and pop retail is likely, I think, to come back a little slower, but it'll come back. We just don't know what it's going to look like when it finally does come back. And we do have a little bit of exposure to that market. And I can say that of our retail tenants, a significant number of them are unable to pay their rent right now. And likely several of them won't make it through this cycle. Hospitality-wise, we've had people cancel on hotel contracts, both in Virginia and New York. And I don't see how they're going to get the capital to build a new hotel right now. Until there's a vaccine, I don't see that market coming back. The office market has been interesting. We have not seen a significant amount of defaults in the office market. We haven't seen any real activity, meaning people wanting to grow or shrink. But we are hearing a lot. I was on a call last week with representatives from Boston Properties, Brookfield Properties, JBG, some of the larger office owners in the Mid-Atlantic, and the term hub and spoke came up a lot. And where people that own significant portfolios in the downtowns are seeing their office tenants maybe not giving up the space in the downtowns, but looking for space outside of the downtowns where they can give their employees a location that's closer to home, provides a little bit more social distancing in a broader footprint, and then figure out what to do with their downtown space. So I think the downtown office market is something that is going to be certainly a wait and see, but the suburban office market I could see enjoying a bit of a flee from the city. That also is very true in suburban multifamily, which we have big exposure to. There's been a big cry that the city is going to lose a lot of people, and that they're going to be afraid of density. They're going to be afraid of mass transit, and they're going to want to be in the suburbs. So for Long Island in particular, it's very good news for the multifamily market, but the multifamily market, as we know, is extremely upside down in supply and demand already. So if we're going to increase the demand in that market, we really need to figure out a way to continue to feed the supply, and it's a very challenging region to do that. And then the last thing that Long Island probably would love to see, I know there's a couple of projects that are proposed for it, and it's certainly a product type that is going to increase in demand, is that last mile industrial, right? So the sort of logistics / fulfillment center for the e-commerce companies. And obviously e-commerce took a big jump in the pandemic, but that trend was happening anyway. And I don't see that declining. I see that increasing going forward. Long Island, we just don't have, we have obsolete industrial, 14-foot, 18-foot ceilings. We don't have the 50-foot ceilings with super flat floors and the ability to, with 150 truck bays. And we just don't have that last mile type space. And I know there's some of that proposed for the Newsday site in Melville. I think that's great. So those are the basic property types in the commercial sector, and the way that we view them right now. The capital market side, they were frozen from March until maybe about 3 weeks ago. Everybody would say, we love your projects, we love doing business with you guys. We just have no idea when we will be able to go to our investment committees and say, let's take on a significant new project. They were all talking about having some clarity at the end, but back in March, they were like, well, maybe by April 15th we'll know, and then it was maybe by May 15th we'll know. But we have seen in the past 3 weeks in both the equity and debt markets, the banks were saying, all of our lines of credit were drawn from customers that had never drawn their lines of credit for years. And the credit of those customers that are pulling the lines of credit is deteriorating. So we don't know what our capital reserve requirements are going to be to back up the lines that are being drawn, and how, for the larger banks, how we're going to be affected by energy and hospitality and travel and all these huge industries that are calling on their reserves. So again, just recently we've been hearing that, all those lines of credit got drawn, but then they were redeposited with the banks and checking accounts. So the banks are paying, 10 basis points or 40 basis points on a checking account, and they're getting 1.75 basis points on a line of credit that wasn't 1.75% on a line of credit that hasn't been used in 10 years. Right. And so they're actually making money on all those lines of credit that came out, and the credit hasn't been hurt that bad on the people that owe the money back, and the cash is sitting in their bank. So they're starting to say, you know what, we do see some more clarity that we might be able to do some business on some new projects this year. So we're starting to see some hope.
That's great, and that's really, from my perspective, I'm starting to see the same thing now that construction's been opened up in New York here. Certainly a flutter of activity. So you guys, one of the things that I've always been impressed as I've watched you guys is you guys were way ahead of the curve, realizing that there was going to be a shift as to how commercial space was going to be utilized in the marketplace, understanding that that apartments were needed in revitalizing downtown. It seems like COVID is actually helping you guys move in that direction. By forcing people to refigure and reconfigure what retail space is going to look like and big box space is going to look like long term. But what about the housing market? So there's been a lot of talk about about the housing market being distressed, the apartment market, single family home market. How have you, from a landlord's perspective, what have you guys been seeing? How have things been moving in that direction? And do you see that market expanding in the near future?
Well, as I mentioned before, the biggest challenge to expanding the market for multifamily on Long Island is getting the approvals to build them. So there's a huge imbalance. If you look at the Roush, the Long Island Index studies, we need anywhere from 100 to 150,000 more units of multifamily on Long Island. Our demographics have changed dramatically over the past 30 years. Over 20% of our households are now one person, where 30 years ago, that was less than 10% of our households. 30 years ago, almost 50% of our households were two married adults with children in the home. Now that's down into the mid-20s percentile of households. There is a huge demographic shift, and yet, if you take the town of Brookhaven, for example, still over 90% of the dwelling units are single-family homes. Right. But a significant portion of the population doesn't want that. And we've been fighting it because most, including my family, most families here came from Brooklyn and Queens. It's a unique suburb that way. It's been almost purely an east-west migration, a west to east migration, right? And everybody came from Brooklyn and Queens and says, I don't want the Queensification of Long Island. I left Queens for a reason. And what they don't see is that the rest of the country has beautiful suburban nodes where the density is around a downtown or around a train station or around an employment center, not in the middle of all the single family homes, not in the middle of a farm field somewhere, but carefully chosen areas for density that provide a vibrancy and a choice of housing that an awful lot of our population want. There's an awful lot of our population that aren't renting because they can't afford a house. They're renting because they don't want a house. They don't want, the tax bill. They don't want the maintenance bill. They don't want to deal with the house when they go away. They want to turn their key, go away. If their sink breaks, they want to call up and say, my sink is broken. Come fix it now.
They want the ability to live near a mass transit area, near a coffee shop, and a downtown. They don't need all the aggravation that home ownership brings. And I think you're right. That's a great trend going forward.
It really is. And the average income in our three most recent projects is over $100,000 a year. At one point, our Port Jeff project had an average income for applications that was over $200,000 a year. These are not people that can't afford a house. And I think there's there's an awful lot of fear mongering in the entitlement processes when people propose projects like we propose, and people say it's going to ruin the school district. People say it's going to, bring traffic. People say, well, most of these things reduce traffic because people are walking to the restaurants from where they live. People are walking to the train station instead of driving and parking a car at the train station. And they don't hurt the school districts. I think in our over 500 currently occupied, in the three most recent projects, and over 500 recently that are currently occupied units, we have approximately 25 school kids total. It's less than 0.05 per unit. And yet, even with IDA abatements, the taxes that those projects pay are, substantial, seven figures, and it's a lot of money. And so it's a huge net positive. I know the Pat Med School District, in a forensic analysis of multifamily development in Patchogue, it was shown that they netted a net benefit of over $5 million a year from the presence of all the multifamily housing and the economic impact that those tenants have on the area. And the homeowners in the area, the values of houses around downtown Patchogue have escalated significantly greater pace than the values of houses on Long Island in general. Because now, before you used to get to walk to a war zone if you lived near Patchogue. Now you get to walk to 45 restaurants and entertainment and a lively, bustling downtown. So the value of your home, if you're walkable to that downtown, has escalated an awful lot. So people are finally at a grassroots level starting to recognize how backwards we've been in our entitlement process. And what I would have always termed our Euclidean zoning, right? Office will be here, retail will be there, industrial will be over here, all housing will be in these single family homes, and our downtowns will be purely shops, and it doesn't work. It's not what any generation today wants. And so we see that trend continuing.
The success of that, Jim, the success of that model, which I wholeheartedly believe in, though, depends on these small retail establishments in those areas to survive, right? And to be able to thrive. And so what are you seeing there, right? Because that's my concern, is we finally got this right on Long Island, and we've worked really hard to get these areas opened up, right? So what do we need to be doing now to be saving these small mom and pops in these downtown zones? Because that's going to affect tenants, right? Because if they can't have that, then they're not going to live in an apartment.
Yeah, I mean, look, until we get to clarity on the back end of the virus, I don't see people sitting shoulder to shoulder at a bar. I mean, it's obviously that's not going to happen immediately, and there is not a lot of clarity on what downtown retail is going to look like. I still believe that we are going to find clarity at the end of this virus at some point, and that people do want to congregate and people do want to go out to dinner, and that's really where those downtowns have gone into sort of experiential retail, where people can go out and get entertained, for lack of a better word, whether that's at a meal or some other, even if it's just a downtown park or just walking around and checking out the shops.
Sure.
So that I don't think is going to change. People want to be with people, and when we get some clarity in the back end of the virus, I think that will come back. it is hurting a ton of our retail tenants right now, really badly.
Right.
And we're obviously going to work with them and try to figure out a way to help them survive.
And Jim, that's what I wanted to ask you about. I mean, how much wiggle room can they have before it gets dicey? I mean, if it's bad now and this thing sort of lasts before we get normal again until, who knows, 3, 6, 12 months before a vaccine perhaps that really quells it. I guess I worry about how long can they withstand this environment. Clearly, the restaurants, the bars, the retail outlets are in a world of pain right now. They are doing Herculean efforts to pivot, and it's great, the takeout and I guess the retail curbside, but that's not going to be enough. And so I worry that they don't have that sort of cushion to keep them going for very much longer.
Yeah, I think that's true. I think there are an awful lot of our Main Street retail people are fairly substantial. Maybe they'll have a half a dozen or a dozen locations around Long Island, and they have different themes and they're substantial businesses in and of themselves. But there's also an awful lot of mom and pops who have put everything that they have into that one storefront and are struggling. And we're going to try to work with everybody that's in our buildings. But I think that sector of the real estate market is going to need some help. And what it looks like at the back end, I don't know. I know landlords are going to have to help for everything we can do. I know that they're going to need SBA help. They're going to need some federal assistance to really bring back that Main Street retail. But that retail, at least, I think in the long run, is worth investing in because it's not going to be replaced by e-commerce. You're not going to get an experience over the internet. You may get all your goods and services delivered to your front door, but you still want to go out and have dinner with your wife or your girlfriend or your significant other, whatever. You're going to want to go meet friends and watch a ball game or something. So it's not that experiential retail. There'll be a demand for it at the back end of the virus. Where, do I think we need a 1.2 million square foot mall with big department stores on anchoring it and fields of parking outside? I don't think that model is going to be in demand at the back end of this. Yeah. But I think Main Street retail will. It's just we got to help the people survive to get to there.
Yeah, and I'm hearing some good things coming out of Washington about allowing deductions for meals and travel and all that other stuff to incentivize it on our end. But there's going to need stimulus. There's going to need to be stimulus dollars. We can't just let an entire industry. I mean, the eclectic nature of non-chain restaurants is what intrigues me. Chain restaurants are not something that I appreciate, right? I don't want a cookie cutter experience. I want a unique experience.
Right.
I think that's what's really going to attract the downtowns. Let's talk interest rates. Peter, let's start with you. I mean, the bond markets, interest rates, borrowing, where do we see that? Because that's going to be a very important way for us to grow out of this. Debt is going to have to be, people are afraid to go in debt right now, and I understand that. But debt long-term is going to be the way we grow our way out of this. What are you guys seeing? We'll start with Peter, and then Jim, I want to hear from you as well.
Yeah, the one entity that's not afraid of taking on more debt has been our Fed. I mean, the amount their balance sheet has increased is astronomical. And so you wonder, and again, it was the right thing, and we needed it, and it's certainly a bazooka of stimulus that came out in April. And I heard it from you, Joe, there's more coming. It seems likely there's more coming. But what does that mean at the back end? How do we simply print and not have some negative impact to that? So I do think that interest rates right now are, historic lows. They did a bit of a jump last week on the 10-year. We're now at 82 basis points. I can't believe I'm even saying that. 82 basis points for a 10-year United States guaranteed bond. 82 basis points. So very low interest rates. My guess is that over time, as the economy does get its groove back, and yes, it might take some time for that to happen, and it's going to be different for sure. My thinking is that rates will gravitate higher. but not in the short term. I think Jim is right about that.
Yeah, I'll tell you, I've been studying a lot about the Fed lately. It's renewed my interest with this. In 08, 09, everybody was outraged that the Fed's balance sheet grew to 4 trillion. Now we're eking up on 8 trillion. And the more I read about it, the more unusual it is, right? So the point of them deploying currency is to get the job market high. Two missions of the Fed, right? Control monetary policy and keep the job market high. They've been deploying all this capital while the job market was going to record lows, so we don't know where that's going to take us. But Jim, your business is very tied into interest rates. What are you seeing? What are you expecting over the next 12 months or so?
Well, we are very tied to interest rates, and we, as Peter was saying, we just don't see the pressure. I mean, I agree with you. The Fed's gone, up to north of 7 trillion on its balance sheet, and people are saying it might be 9 or 10 by the end of the year. A huge percentage of that is in bank deposits that they're paying 10 basis points on, and another huge percentage of that is treasuries that they've got on their balance sheet. But I mean, they're not taking a ton of credit risk. I know that they were allowed to buy, I don't know if it's 10 or 20 billion dollars worth of corporate bonds as well for the first time. But in the size of their balance sheet, their credit risk there is de minimis. They have some interest rate risk at the Fed that if short-term rates were to rise, they're kind of like the S&L, right? The old S&L crisis where they had, the S&Ls had 30-year mortgages, but they were paying, but their cost of money was daily deposits, right? With the rates that they were paying on CDs and daily deposits. And when the short-term rates rose higher than what the long-term rates were on their assets, then they were upside down. They were earning money on 30-year mortgages that was paying them less than they were paying on their short-term obligations. So if that 10 basis points that the Fed has to pay goes up north of what they're earning on their treasuries today, which is somewhere blended, it's like 2%, they could be upside down. But the only way that would happen if there's enough economic activity to drive interest rates back up. And in macroeconomics, that I don't think that's a big risk. If the Fed loses a little money, but it's generated but the strategies of generating enough economic activity to drive interest rates back up past that level, that wouldn't be the end of the world. But in a nutshell, with the 30-year trading, I think it's like 1.4 something today, and the 10-year, as Peter said, being below 0.9, there's no indication that the market believes that in any window in the foreseeable future, you're going to see a significant increase in interest rates, which in some ways to us is very comforting, right? So we build projects that are valued based on the yield that they create. So if you can earn, $100 off an apartment complex and somebody's willing to take, or if you can earn $50 off it and somebody's willing to take a 5% return, that asset's worth $1,000. Well, if they're willing to take a 4% return, that asset's worth like $1,250, yep. Right? So the fact that there's going to be downward pressure on rates in our market turns it into capitalization rates, right? So we view that there's going to be pressure, particularly on multifamily capitalization rates, to come down, which means that the value of those assets would go up. And that's a good thing. We also see that the availability of capital, particularly the FHA-backed multifamily capital that's in the market today, we were quoted 2.4% on a 35-year self-amortizing loan from the FHA. I mean, I wish I had more projects that I could back the truck up and load it up with money at 2.4% over 35 years. I mean, we should be deploying as much of that capital as possible right now. So yes, we see it as
so that's the pressure we should be putting on these municipalities at this point, right? I mean, now's the time. Now's the time for everybody to have a win-win-win.
Yeah, absolutely.
So let's talk a minute about 08, 09, right? So everybody's trying to understand this because we've all lived through 08, 09, 010. From your perspective and in your market, Jim, what are the differences and the different challenges that we're seeing now?
Well, the big difference to us is the health of our capital sources, right? So prior to the 09 collapse, our equity partners included the largest financial services company in the world, the largest industrial company in the world, and probably the largest real estate equity fund in the United States. In 2010, they all needed liquidity. They couldn't pay for flights to go look at projects. They couldn't fund an architect's bill. They were all upside down. And the banks were in trouble. The banks did not have liquidity. Their reserves were tapped. They were looking for bailouts. So we spent 2010 to 2012 buying out some of the largest financial institutions in the country from our projects. I don't see that happening now. We see no distress in our capital sources. We see very little distress in the property markets other than the retail and the hospitality, which thankfully we don't have a ton of exposure to. And, you know, although, as I mentioned before, the capital sources went on pause, we already see that they're coming back. We have 2 projects going to investment committee next week for equity sources. We have 1 going in for debt next week. There's, you know, we're getting calls from our large banks saying, what do you have coming up? We want to make sure you know we're here for you. We're still working through the kinks, but for existing customers and good projects, we want to show you that we were conservative going into this, and we're well capitalized to help, you know, work our way back through the back end of it. So the biggest difference is the health of the capital sources in this round, and so that's why I'm very hopeful towards the back end of it.
Yeah, so a couple questions have come in, and I think I can summarize them all in one question to you, Jim, and then I'll flip it to Peter on a different matter. But of all the projects you had that you were considering prior to COVID here on Long Island, has this made you rethink any of those projects in terms of whether you want to move forward with them or not?
Certainly not on the multifamily projects, which are our biggest projects in the pipeline right now. You know, our next phase of Ronkonkoma Hub has a significant percentage of retail in it right now. So we're trying to find a way to mitigate and isolate that risk for our capital sources. And I think I'm cautiously optimistic that we're able to do that. On the multifamily side, there is just infinite demand still on Long Island, and very little risk that they're not going to lease up. And, you know, the hardest part has been getting the entitlements to continue. And now with, you know, with virtual public hearings, you know, that process at least has a window to be able to move forward, which is great. But no, we are not putting a pause. The capital markets paused for a little bit. Really didn't affect us that much because we weren't looking to close on these. We have 3 projects in the pipeline for Long Island. We weren't looking to close them until the fall, and then into early next year. Between those 3 projects. So all 3 of those still are full steam ahead right now. We've not slowed down.
That's great. That's really great, encouraging news. Peter, the securities markets, right? I know you're a very cautious guy, but, you know, I've been watching Boeing pretty carefully, right? Ever since Boeing and their commercial aircraft didn't do so well. Now all of a sudden they're skyrocketing. The markets continue to skyrocket. Where are you at with all of this? Where's a nervous guy like you at with all of this?
Well, I would say more thoughtful than nervous, but okay. I think that I'm less inclined to speak about individual companies, but
yeah, of course.
I think it's laughable that you talk about, you know, rocket ships, because we had companies now shooting people up to the moon, and that's apparently a business for whom I don't know, but I guess the folks that run those businesses will try to find some hardy souls to shoot up to the moon for to space. Here the bottom line is this, Joe. The bottom line is, when you look at finance and you look at investment analysis and you go back 50, 100 years and you try to determine the factors that make the most impact over a 3 to 5 year period, not short term, because short term is just noise. And, you know, Warren Buffett's famous quote that in the short term, the market's like a voting machine, a popularity contest, although in the longer term, it's more like a weighing machine where empirical evidence matters. I think is really important right now to look at those factors that determine investment success. And the number one highest correlation factor over 50, 100 years of studies is valuation, is what you pay when you buy something. And right now, things are elevated. So it would be taking, I think, a leap of faith to get very aggressive in this market at this time.
Yeah, so I always am interested because my understanding of the market is it's valuing what they think it's going to be a year from now, not today, but a year from now, in essence, right?
Future cash flows.
Yeah, and there's no way to really understand what things are going to look like a year from now, yet they're optimistic. So what that tells me is there are opportunities, but it's up to us as business leaders and entrepreneurs to figure out what those opportunities are going to be, which may not be very clear right now. And I think that's the same in the real estate market, Jim, is, there's always going to be a need, right, for us to have shelter. There's always going to be a need for us to be social and to gather. But as we look at, and even things like municipalities weighing disbanding police departments, and what is that going to do for consumer confidence being out in public spaces and public restaurants? We just don't have the answers to these things, right? So how from a development perspective, Jim, how are you guys digesting and calculating all of sort of the social changes as well?
Well, I mean, we try to look at them, the social changes and what do they do to the way that people need and treat space, right? So we've been in this pandemic now for 90 days and, April, and we've been leasing up our phase one of Ronkonkoma Hub. We finished 489 units there. We started occupying the first buildings of the 6 buildings that make up that project, the first phase of that project. We started occupying them in June of last year. We had our best leasing month in in April, and we've had a very good leasing month in May. The volume has maintained. People do need a place to live, and people are trying to get out of the city. Our health sector is growing. Our healthcare sector is growing. We've seen our academic sector has not slowed down hiring. So we're seeing significant demand still, and we were quite frankly surprised. We all thought that in March when things were shut down and we have to do virtual tours, we can't even show somebody an apartment. They have to look it up online and then they're signing a lease and moving in based on that. So there is an amazing pent up demand for apartments, and we know that. So we don't need a lot of clarity at the back end of the virus to know that multifamily on Long Island is still in desperate demand. Yep.
There's no better indicator than what you just said, by the way, that people need it so bad, they'll do a virtual tour and sign a lease.
Absolutely. It's amazing to me. Now, office is going to be an interesting study. In our office, for example, we're not sure. We're planning a new office down at Ronkonkoma Hub right now. That's where we're going to move our headquarters. And, it's hard to see what that space should look like, right? Right now, that space should be much more distanced than maybe it needs to be a year from now. And I think employers in general are trying to figure that out. We also found that we are very effective from home, right? So we are, most of our people, we can certainly do financial analysis at home. We can do
I think he's muted.
Jim, we lost audio. Did you hit mute?
Mute there. Even though I think that the work from home sort of is a headwind against office space, I still believe that there's a huge productivity element to sort of the engineered serendipity of being near people, right? Of bumping into somebody and saying, "Hey, Joe, what are you working on?" And you tell me what you're working on, and I say, "Hey, listen, oh yeah, you know what? I was talking to some other guy about that the other day," and I just think that the human interaction being significantly decreased is going to have an impact on both the culture and the productivity of businesses more than we're currently realizing in the work from home environment.
Yeah,
I think office is going to be interesting at the back end of this.
I fully agree with that. I think
you're on mute, Joe. Wait.
I hear him.
Oh, I got it. Sorry, thanks.
Yeah, I think it's right. You can't just make a global statement that people can work from home. Yeah. There are certain tasks, right, that are better off being done from home. Attorneys can research and write briefs from home. They can't collaborate and brainstorm over the best creative solutions to a problem at home. It's just not going to work. You can't text. It's not convenient. You're going to miss steps. There are things that are not going to happen. And so I truly agree. We all have to rethink about that. So that also makes me wonder, are you rethinking what apartments need to look like, right? What floor plans and spacing needs to look like going into this new wave of society?
Yeah, I think it's more the common areas really need to be, thought about more. The actual homes themselves, once you're in your pod, where all of us have less fear amongst, the people that we live with, I don't think we need to create more space between people inside their units, so to speak. But there was already a push. One of the number one amenities that new Class A apartment projects want to have is a co-working environment, because even pre-COVID, there was a trend towards remote, employees, people working from home, and many of our Ronkonkoma residents are people that maybe go to meetings in the city every now and then, but basically work from home, and so they can hop on the train and go to a meeting, but we need a co-working environment where they can get out of their apartment, sit in an area where other people are also working, have some human interaction, and still get their work done. And so those co-working environments, almost like a private WeWorks, right? It was kind of a major trend in amenities for apartments, and that space needs to really be rethought. Like how are people spaced out in that space? What does that space look like? Obviously fitness centers are challenged. You can't just have machine next to machine next to machine. And I'm not smart enough to tell you what that looks like at the back end of this, but it's going to have to be rethought. So the common areas, I think, of the projects that we put together, are going to be challenged to be redesigned. And then the same is true in office space. How do you actually get into the building? What are you touching? What do your bathrooms look like? How do you make it as hands-free as possible? How do you make hands-free entrances, so that you wave your phone in front of it and you get into your office building? How do you make hands-free elevators? How do you monitor and give comfort to people to get in an elevator with somebody? So there's a lot of space use challenges that need to be thought through, and I don't have the answers today, but I don't think they're going to fundamentally change the demand for certainly apartments. And I think office, there will be a demand. I'm just not sure if it's going to slightly grow or slightly shrink.
Yeah, so quick question that somebody asked, from Long Island versus national, are we on par with where you see national development taking place? Are we behind? Where do you see Long Island in a context of the rest of the nation?
Well, as I mentioned before, studies show we need somewhere between 100 and 150,000 units of multifamily on Long Island to be in balance with the rest of the country. So we have, somewhere around 80% of our dwelling units are single family homes. There's a demand, and that's true across the country, of more like 35 to 37% of dwelling units need to be multifamily rental. Right now we're at 19-20%. So that's a lot more units that need to get delivered. The rest of the country is not that way. Like and again, it's due to the entitlement process here, but in our Virginia market, there's a lot more equilibrium because it's easier to get projects started. So if there's a demand for new apartments in Northern Virginia, you can get a project approved in 6 to 8 months and get going and address that demand. On Long Island, that could be 4 to 8 years to get that project going, and it's just really, really difficult to get them started. So, and as an industry, I'm the president of Libby this year, and my fellow builders and I, as an industry, we're delivering less than 2,000 units a year. So there is a huge runway of pent-up demand, and it's the NIMBYism, it's the false facts about school district impacts, it's the false facts about traffic impacts, it's the false facts that it's all going to be co-op city and Section 8. If somebody took a walk through one of our units, I think, or one of our buildings, it is nicer than almost anybody's house, than 98% of the houses on Long Island. And they are not Section 8. These are very, very nice places to live. So there's a lot of false information that gets put out when people are fearful, and there's a lot of fear mongering. People take advantage of that fear and try to stop projects. And we as a community are finally waking up and speaking up and saying, that's just not true. We're not going to hurt the school districts. Not true. We are not going to hurt the traffic situation, and not true. We are not going to decrease the value of homes. We're going to increase the value of homes in the area.
Yep, it's that old saying, I love Long Island. Long Islanders, not so much, but I love Long Island, you know? All right, last comments. I always like to make sure you guys give some optimistic final thoughts. Peter, I'll start with you. Give us some optimism. Give us some hope here.
The economy has pivoted. Businesses, small and large, have figured out how to operate their business in this new environment. We don't know how much longer this environment's going to be with us, but just the fact that we're able to pivot and operate and do so virtually and do programs like this just shows you the resilience of the American spirit and the American economy.
Yep. Jimmy?
Well, I agree. I think it's all of our jobs to give each other a little bit of optimism in these times, and I think there's real reason for that optimism. I mean, we've seen it. I feel in our own group chats within TRITEC, we do a weekly call with the entire company, and there's a esprit de corps where people they've got each other's back. They're proud of what they're doing for a living. They're proud of what the impact that they can have on their community. They want to be able to keep making that positive impact. And we're starting to see, as I said, in our capital market, we've seen in our demand for our product, incredible resiliency and amazing productivity on the leasing side. And then on the capital market side for future projects, we're seeing that people are getting the confidence to call up and say, we're going to go to committee with your project next week. And that is super encouraging and exciting from our perspective.
Yep, and from my perspective, I see people have a lot of cash right now, and that's always a very good indication to me when people have cash. If the demand isn't there, it'll get there, because we're all chomping at the bit to get back in terms of giving us opportunities to deploy our cash. But everybody has a lot of cash right now, which is a good sign. I think that's a really healthy ecosystem for us to be waiting to see how this blows over. Certainly better than the alternative. There's a bunch of questions we didn't get to. We're gonna email you answers. I'll circulate them to the panel. We'll get answers and email them out to people. We gonna go now so people can go and try and make some money and work so hard. Jim, thanks so much for joining us. This was incredibly terrific. Peter, always great to see you and get your insights. To our viewers, we'll see you next week, and we'll continue to talk about business unusual with our great group of experts. Thanks everyone, and have a great
Thanks, Joe. Thanks, Peter.
Yep.
Thanks, guys.
Thanks, guys.
Take care.